following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on 94.1 FM WNBU as well as cable TV 10 in New Bern, North Carolina. You may also be streaming us from the web, www.dlblain.com. We welcome you as well. Our show is here for you, the viewers and listeners, so if you have any comments or questions, topics that you'd like us to cover, please send us an email, allthingsmoney@dlblain.com. You can also give us a call. Our number is 252-633-0107. And if you have some time, head on over to our website, www.dlblain.com. There you'll find archived copies of the shows as well as a wealth of information on myself and my firm. Well, now that we've got that out of the way, I came across this great article that I wanted to share with you today. This was from the Wall Street Journal back in October 30th. And it's the premise of the story, well, the title is, Can You Trust Your Stock Jobber? And you may be wondering, what's a stock jobber? Well, when stocks first came out back in a long time ago, you know, actually around the 1500s, people that sold them were called stock jobbers. And now, of course, they're called stock brokers. But anyway, they're called stock jobbers. So this study, thanks to some of the exquisite record keeping over in the UK, they were able to, the actual stock ledgers exist for investors building portfolios from 1690 to 1730. And so these researchers from the University of Illinois replicated all the holdings and trades in the Bank of England, the East India Company, United East India Company, Royal African Company, Hudson Bay Company, the Million Bank, and the South Sea Company. Now, you may have heard of some of these from your high school history classes, the South Sea Company, the East India Company. But these were actual companies that you could invest in. You could put money in, and just like today, Coke, Pepsi, GE. One of the things that's fascinating is that these registries of the shareholders were preserved, and so they were able to match every investment with the name of the person who held it, encompassing 5,813 investors during the 1690s up to 23,000 by the end of the period. And these investors included dukes and aristocrats to the stockbrokers, merchants, glassmakers, drapers, goldsmiths, and up to 27% of them were women. And so we have this glimpse into behavioral finance. The reason I'm going through this is you always hear, maybe you don't, but I do, and if you watch CNBC or something like that, oh, this time's different, and this is different, and this is different. And I'm going to show you that even back in the 1700s, people were making the exact same mistakes that they make today. Number one, undiversified. 86% of them own shares in only one stock. And I realized that, there wasn't 10,000 stocks, there's only a handful here, but still, 86% of them only owned one stock. Number two, they chased performance with rising prices leading to higher trading volume. So they reconstructed what people were paying, and so they could chart the prices, and they saw that as the prices were going up, more and more people were buying them. Number three, that investors underperformed the market as a whole, earning lower returns and incurring higher risk. So they took these companies that were in existence and they essentially formed an index, the S&P 500 of the day, and they found that the investors underperformed the market as a whole. it says that women appear to have had more conservative portfolios than men, and we typically see that again today. So the typical investor seems to have diversified across fewer than two stocks. The South Sea Company was far and away the most favorite. Its annuities were held by nearly triple the number of investors. And many of these people were wiped out in one of the first recorded stock market bubbles. When South Sea shares, they fell in price from nearly 900 pounds in 1720 to nothing in 1721. So you can see once again, you have stock market crashes even way back then. So today we see that individual investors on average hold an average of only 3 stocks. They're still chasing performance, and they're still underperforming the market as a whole. And see, one of the things that with the explosion of information today, the ubiquitous of the personal computer, CNBC, all that kind of thing, you can see that we really haven't added anything to our knowledge of investing for the masses. And it's because a lot of these things are emotionally driven. We want to buy more of whatever goes up in value. We want to view our gains and losses in isolation instead of building portfolios. And we think that we're Superman and we can withstand infinite risk when the market is going up, and then doubt that we can survive any risk at all when the market is going down. And so you see this behavioral psychology of humans has not changed that much since these first stocks have been around. And so we need to use the tools that are out there today to build better portfolios, more diversified. If you're out there doing it yourself, do you actually track your performance in an appropriate manner to see if your trading is adding value? I mean, some people just look at their account and they say, oh, well, it went up, so I must be doing good, or it went down. But actually track it, against some index or something like that to see if you're doing very well. Of course, for our clients, we report it in black and white, and you can see, and by diversifying, not chasing performance, you can at least match the returns of the market, if not exceed them, which is more than people are typically able to do. So once again, this is a great article if you have a chance. Wall Street Journal, October 30th. Can you trust your stock jobber? And it illustrates some of the fallacies that humans have investing since the 1700s. Once again, they were undiversified, they chased performance, and they underperformed the market as a whole. Well, that brings us to the end of our first segment. When we come back, we're going to be talking a little bit about healthcare reform and what it means in 2013 for you. So for All Things Money, I'm your host, David Blain, and we'll be right back after a few short messages.